Welcome to another podcast for Investing Education Academy. This time we're going to tackle some kind of a different spin on today. There is still a lot of fear, a lot of people trying to figure out what's going on in the market, and Leon and I want to do what we can to help you all kind of understand really what's going on. So for the most part, I'm going to let Leon tell you why we're talking about what's going on in the market right now. Some of you all might want to do some, and so the title of this was how to capture losses in your investment portfolio. That actually works for this unintentionally, but
yeah, I just saw it. I was like,
I just saw it too, because what we're saying, some of you all are thinking like the sky's falling. So again, we're going to talk about what the actual topic is for today. Leon's going to tell you while I do some housekeeping.
Yeah, so the title says how to capture losses. That's for the Three Money Amigos. Showing we're human. We forgot to change the title, but kind of works because as Brent said, we're going to talk about like I said. So the market is utter crap right now. Like we all know that. Monday, either I think it's yesterday or Monday. I think it's yesterday. The Nasdaq was down 5% in one day. Between 4 and 5%, depending on when you what you're looking at, the futures or the stocks. But it was down, let's just say 4% in one day. So that means individual stocks, some of them were down, multiples of that. So it was a horrific day yesterday. But as Brent and I have done, we did a I think 1 or 2 podcasts before where we show, we're always proponents of, the stock market goes from the bottom left to the upper right, right? Like it goes, goes like that or like that, depending on how you're looking at the screen. But it goes, bottom left, upper right. But during times like this, it doesn't feel like it, right? Like, and it feels like it literally goes top left, bottom right, right? And what we're in right now, yes, it is doing that. But what we're going to show today is we're going to give another glimpse of perspective on what's actually going on, right? So in the moment, it sucks. The Nasdaq is down for the year, which is mostly tech stocks, is down about 18% for the year. The S&P 500, which is the general stock market, is down about between 10 and 13%. This is one of the worst starts to the year in the history of recorded markets. Not the worst, but one of the worst starts for the year. So there's that, right? So this is, but again, this is not normal, but we all know why this is happening. The market now is facing, what is actually the first time in history is that the market is facing 4 or 5 different headwinds that it's never faced before at one time: pandemic, war, inflation, and the Federal Reserve being uber aggressive. Usually one of those things in one year will be enough to have the market topsy-turvy. We have all like 4 or 5 of those at one time pounding the market daily.
Oh, don't forget about supply chain issues.
Oh, yeah, right.
Semiconductor shortage, and then you have major plants shutting down. So,
right. Oh, yeah. I forgot about the shipment. So people that don't know, China, which is the second largest economy on the planet, next to the U.S. economy, where much of the supply chain, that a lot of goods that are made in America are made in China. Well, a big portion of China right now is shut down because of COVID. They're having another huge outbreak over there. Many of the major cities are actually on complete lockdown. They have something that's called COVID-0. What that means is if even one person in say an apartment building gets COVID, they lock down the building and they lock down the surrounding. I don't know how big, but they lock down the surrounding area. Then if somebody else in another area gets it, they lock down. So if one person gets it in a certain geographical area, they lock down that area. Just one person. They call that COVID-0. So a lot of the plants are shut down. A lot of the manufacturing is shut down, which again is another headwind the market is facing. So we're all going through it. Brent and I are going through it too. We're feeling the pain. But like I said, today we're going to give perspective. Perspective.
Yeah. This is going to be fun.
Keyword for the day is perspective.
So if you are watching this is a good time to share. And if you want, I would say this is one of those episodes you want to pull up your portfolio and maybe do this exercise with us, with some of your stocks inside of your portfolio. You're going to understand what that means as we dive in today. Share this one, pay attention to this one, call your kids in, because again, this is one of those kind of dots on the graph when it's going bottom left, upper right that looks like a drop and feels like a drop right now. But this is where people become uber wealthy, or they capture those losses because they're freaking out and they don't know how to push through this. They don't know how to, because Leon and I always say you should have a long-term outlook on your portfolio between 3, 5, 7, 10 years in some cases or more. However, please understand, Leon and I both fully agree on this. There is a time to reallocate your investments. And there's a time to understand that economies change, markets change, industries change. And so whatever sector you're in, you may think, oh, it's been doing well for this long. It's going to go for an infinite number of years up. That's not always true. And so as much as, and I want to say this again, as much as Leon and I say, timing the market is better than timing the market, you still want to be smart about how you invest. And right now, if you don't have a professional that you're speaking to about the market, if you are not a member of IAA or some other group, you should be. Because I promise you, this is where I would say retail investors make the biggest mistakes in their portfolio. Hands down. This is the market where a lot of you all are going to make some of the worst mistakes you've ever made, and you will not realize it until 4 years from now. You might feel it in 2 years, but you're not going to really understand it for like 4 or 5 years. And you're going to look back like, what was I thinking? And Leon and I are trying to do our part. We're trying to do our part and tell you all about the market. These videos are free. This podcast is free. Please pull up your portfolios, everybody. Buckle in, because what we're about to show you matters.
And real quick before you do that, so what Brent said about reallocation is true. We said back in November, look, tech stocks are going to get rough, right? Unprofitable, high valuation tech stocks are going to be rough. A lot of people in the IA community definitely have reallocated or sold out or sold some of those high valuation stocks and missed a lot of losses, right? Myself included, Brent included, a lot of people included. Today was a perfect example of why that should have happened, or at least started to happen months ago. Teladoc reported today. They reported earnings. I don't know if anybody saw this. Teladoc reported earnings today. The stock was down 40% in after hours today. 40%, right? Teladoc is a hugely overvalued, non-profitable tech company. It is the quintessential COVID winner from 2 years ago. Things that worked then, as we said, are not working now. They missed their number. The stock dropped 40% in
Hold up, Leon. We can't hear you. No, not sure what happened. But while he's fixing that, let me tell you all about Teladoc. If you're again part of IEA, we talked about dropping Teladoc probably in February of 2021, ahead of all this. It was a premier stay-at-home stock. It was a premier stay-at-home stock.
I'll be back. You keep going. I'll be back.
Okay, I can hear you though. So this is like one of those situations. Everybody was seeing their doctors virtually. They had market dominance. But when the world opened back up, when we adjusted to COVID, it no longer was a situation where you had to use the Teladoc system. Also, things like Zoom, other platforms became HIPAA compliant. So you were able actually to meet your doctors through those platforms. Classics. I'm actually really glad I said that, because it was one that we picked during the pandemic. Mm-hmm. And we also said in 2021, we wouldn't hold it anymore. We were like, look, like this time has passed. And so, just if you're not part of a community, become part of a community.
Yeah. So I just want to make that point about, like Brent said, reallocating. We do say hold stocks for 3 to 5, 10 years, if it makes sense. As we said, end of last year, those type of stocks do not make sense anymore in this current market. So you gotta reallocate. And TDOC was a perfect example of why that should have happened months ago. So, all right, so you ready to go?
Yeah. So what we're going to do right now is we're going to show you all a couple stocks. And this is an example of time in the market versus timing the market. I highly suggest you open up your portfolios, you open up your brokerage accounts, and you pull up a couple stocks and do this exercise with us. Call your kids in the room if your kids are around, because this is the type of situation that's going to show them the benefit of staying the course when it makes sense. Now, this is not individual advice to any one person out there. This is just general information. It's not an endorsement of any of the companies we're about to look at, but it is showing you what happens over time. although it feels the way it feels right now. So, let's check it out. We're going to look at we're going to look at this roughly the 6 months for most of these stocks, and then we're going to show you the 5-year mark for most of these stocks. Please pay attention to what you see, and if you're listening to the podcast, we'll walk you through it.
Yep. So the first one I'm going to pull up is a company everybody knows, and I'm sure pretty much everybody uses, is Visa, right? So basically what we're going to demonstrate here is that in the short term, it can feel very, very, very painful, right? That the market is, crashing, feels like it's dropping, feels like it's going to zero. But in actuality, it's not, right? So what Brent has on the screen here is Visa. Where his mouse is last July. So we're talking roughly 7, 8 months ago. Mm-hmm. Since then, so again, everyone knows Visa, the biggest card processor on the planet. They transact, billions of dollars per day, huge company. In this environment over the last year, if you're in Visa since July last year, you're down 15%, right? 15%. When the stock market on average moves up 10% per year, so being down 15% in about a year is a big deal, especially for a big company like Visa. So it feels like, again, in the moment that Visa is crashing, it's going to zero. The market is hell in a handbasket. That's the way it feels, right? But now Brent, click on the 5-year. So again, Visa's down 50% over the last year. Look at the 5-year. You can barely even see on this chart where the current, where the current dip is. Visa over the last 5 years is up 132% for an average annual return of 26%, right? 26% per year on average. And that's with dips. That dip includes COVID, the COVID dip, as you can see on this chart. It includes a big dip back in 2018. So right now we're in the current, I guess you can say Fed-induced dip. But, look what happened since then. Those dips happened. It felt like total crap then too. But as things kind of settled and the economy kind of came back, the market healed itself. So this is one example of, again, in the moment, down 50% over about the past year. Feels terrible. But long term, which we would say 3, 5, 10 years, long term, Visa is up 132%, which is an average annual return of 26% per year. So great return.
Right. This is really important to pay attention to for those of you all who also have kids. This is the reason why we say bring the kids in. If this was the area where you invested for your children, and you're talking 5 years time, you would have seen over a 100% gain in their money. So to give some clarity to that, for those of you all who let's say put $20,000, $30,000 away for your kids' college education, and when they were in 7th grade, by the time they became a senior in this scenario, it's not guaranteed, but in this scenario, you would, if you put $20,000, $30,000 away, you would be talking about holding about $40,000 to $50,000 right now, or $60,000, $40,000 to $60,000 right now. That is what the market can do, even when we're going through COVID environment, inflationary environments, war, semiconductor shortages, supply chain management issues, resource deficient country. I mean, these things are happening right now, and you still, if you put $100,000 away for a house that you wanted, even through all of this, you're talking about, and that's just 5 years, you would now have $200,000. Let's just play for fun. If you would have put $500,000 away, you would now be sitting on $1 million. This is what, and I would really, because I know some of you all thinking, I'm running to the hills, I'm putting everything in my bank account, and I'm just going to let it stay there. Please go back and listen to our podcast about what happens if you miss the 10 most important days in the market. I'll just leave it at that and go to the next one.
Yeah, hey, real quick. I just want to point out. So if you put your mouse, Brent, right near 2019,
yep,
right there. So that drop right there. So what happened that year? The Federal Reserve surprisingly came out and started raising rates out of the blue. The market lost its mind, and Visa here dropped 33% in about a month and a half. 33%. Now imagine that quick of a drop for Visa at that moment in time. Felt like hell, right? But what happened? The market kind of healed itself, went back up. And now we all know the drop of COVID, right? That was, I mean, what's 50? What's 50 into 20 is whatever percentage that is. Yeah. So no, again, another match. I'm curious. 50 divided by, so that's 25%. So during the COVID drop, Visa dropped 25% in a month. Right. Again, in that moment, felt like hell. Right. But again, the market healed itself. Economy came back, and we reached all new highs. Now we're in a moment where we have, as we said earlier, war, inflation, China, Federal Reserve, supply chain, like everything is throwing at the market right now. So we're in one of those uncomfortable moments again. But as it always happens, everything at some point will eventually heal itself and resume higher. So like Brent was saying earlier, if you can, these are times to just slowly dollar cost average into some of these positions, if you can. But also remember this too: cash is a position, right? Don't feel like you have to be out here buying stuff every time there's a dip. You don't have to. If you have money sitting in your brokerage account and you don't feel like buying because we're going through this crazy time, cool. Don't feel the pressure. You don't always have to buy every time there's a dip, but over the long term, it can pay off huge.
Yeah, and we're not talking about go out and borrow money or in Leon risk capital. We used to say it all the time when we first started. And right now, we have one lower that we call curious money. This might be a curious money play for me with a lot of these stocks because although I feel fine I still feel fine investing, but I do feel the pain. Like I'm telling you, Leon and I talked the other day. I was like, emotionally, I just want to cash out all my positions and just hold my money. But that was the emotion of it. Similar to you all saw, if you're in a group, you all know I hold a big position in Tesla. And it was a time Tesla dropped like 30% in 2 days or something crazy. It was like 2 weeks or something. And I was very transparent about it with the group. I was losing my mind. And I was like, okay, I kept saying, this is the floor. I'm going to sell. This is the floor. I'm going to sell. I'm not going beyond this. This is my stop loss. However, after the emotional really side of it passed, the intellect and also the experience that I have with the market allowed me to stay. And you're going to see, what that looks like later on. All right, Leon.
All right, so next one, so Visa we know is a fintech stock, right? They deal with finance. So next one we'll look at is Nvidia, which is a semiconductor chip stock, one of the biggest winners over the last couple of years. But we're going to show you, what it's been doing recently, right? So over the last 6 months,
yep. So in the last 6 months, it's down 26%.
Yeah, so Nvidia is down 26%. Nvidia is down more than the general market. So what that means is Nvidia is performing worse than the general market. Remember, the S&P 500 is down about 13%. NASDAQ is down about, say 18, 20%. Nvidia is down 26% over the last 6 months. So again, painful, feels like hell, feels like crap. You feel like you just want to sell out. But now when Brent cuts on the 5-year, we're going to see, look at this glorious return. Over the last 5 years, Nvidia is up 606%. That's an average of somewhere in the realm of 110, 105% per year, something like that. I mean, Nvidia is averaging over 100% return per year for the past 5 years. So this little, and I mean, in the moment it doesn't feel little, but this little 26% pullback over the last 6 months for Nvidia is a blip, right? Like, would you, Brett, go back to the 5-year?
Mm-hmm.
So you click on the 5-year, and so Nvidia had a bunch of dips in the past, right? As we can see now, that because we're looking back in the past so far back in the past, they don't look big.
This is the COVID dip.
Yeah, they don't even look that big, right? But at some point in the future, we're going to look back at this current dip we're seeing right now, and it's going to look like a small little blip because we're going to be out in the future, and the stock is going to have, most likely have risen much higher than where we are now. So again, perspective. In the moment, it feels like hell. It feels like crap. But as long as you understand how markets work, how they're based on the economy, and they're based on the company's the situation. But again, things we're facing right now, these external forces, they will at some point subside, and we'll see these stocks recover. So just one aside on the economy. With the Fed raising rates, we are starting to see a slowdown in housing, which is good because that's going to slowly bring down inflation. And they're saying they're seeing a minute slowdown in inflation in food. So the Fed is only raised once, but what they're starting to do, but also the effects of what they're doing have raised interest rates also. So what they're doing is starting to slow the economy very slowly, and we want that because we want inflation to subside. So that's a good thing. But as we're showing here, again, don't need to panic, no need to stress. Over the long term, we know that these stocks do eventually heal themselves and return to all-time highs. Nvidia's done it multiple times, and we definitely know, pretty much know it'll do it in the future.
Yep. So I'm going to jump into one of the elephants in the room. Everybody's like, what in the world do we do? And that is Netflix. So looking at Netflix stock, this thing has just been tumbling down. So there's a couple things that have happened. We've had some conversations where we were talking to people about, Netflix, where it's at right now. And you're talking about in the last 6 months. 6 months. Netflix is down 72% in the last 6 months. So when you think about that, imagine you made your first investment in $100, and now $70 is gone, $1,000, and you're talking about now $700 is gone, or if it was $10,000, $7,000 is gone. That's the market, but this is also why you diversify. So as we talk about these things, this is why you normally don't want to have what is called single stock risk, because if this does happen, it can wipe out your portfolio. And there's very, very few people who will argue against a diverse portfolio. Warren Buffett is one of them. But are you Warren Buffett? Do you have a track record over 30% per year for the last 60 years? If you do, cool. So please call us too. Aside from that, most people shouldn't be in a single stock. Now, this is also one of the reasons why I am reasonably a fan of NFTs for situations like this, for diversity, and to get that money management piece without paying the fees to a normal brokerage house or traditional broker who's managing your money individually. So just something to think about. I want to throw that out there because I know normally I poo-poo NFTs, but I don't think I've always said I don't think they're all bad. I just wouldn't do it. Now, with that being down 72% in the last 6 months, if you have held Netflix longer than 5 years, 5 years or less, 5 years or more, you're looking at least a 23% rate of return. As negative as it feels right now, if you have held it for that amount of time, you're now looking at a stock that is still has returned 23% over the last 5 years. So you're like, well, that's not great. It's only like 6-7%. Okay. But when you look at that over 5 years, you're still beating the banks. Like
you're beating the banks, you're beating bonds,
you're beating inflation up until now.
You were crushing inflation up until now. And like looking at this chart, you look at the chart and say, well, damn, you're up 23% now. But before this drop, you were up like, I don't know, 100%, or you were up like 300%. True. That's facts. But the point we're trying to make is that just because the stock drops hugely in the moment doesn't mean that it's a bad return. Doesn't mean it's a bad investment. Now, again, we're not endorsing any of these stocks. These are not our picks. We're just using it as examples. But what we're showing is that even a huge drop of a widely held popular stock, over the long term, it can still be up. So Netflix is down 70% in just 6 months and is still up 23%. So that's what we're trying to show, that over the long term, we can absorb some of these huge drops.
Yeah, and now I own Netflix. I'm telling you now, I am not going to be holding it for the long term. I think the competition's too stiff. There are other opportunities out there. So I'm going to liquidate my positions in Netflix soon. But also you should know this. I've owned Netflix for like 6-7 years or more. So, my return in Netflix is still positive, which is why I'm kind of relaxed on the loss. Now, you want to have perspective too when you're investing. If you invested in Netflix 6 months ago and you're now here, you don't have to hold it forever just to go long term. This is one of those times where reallocation is something that you might want to really think about. Personally, and I'm just throwing this out here as this is a freebie to you all. For me, and Leon, jump in if you feel differently. Netflix numbers are changing. Now, yes, granted, they did do something very almost philanthropic, if you will, when they pulled out of Russia, but they lost like 500,000 subscribers in a moment. So that hurt them right there. And then they're still estimating that they're going to lose millions of subscribers over the next couple of years. In addition to that, they're talking about changing their model where they're going to start addressing lower tier subscribers by way of putting commercials into their platform. And for me, that feels like it's going to push them into competition with things like YouTube and some of these platforms where if you pay premium prices, they actually take the ads away. Because normally we associate those non-paid platforms with having commercials, not the paid platforms. This is also too where I'm gonna say competition like Disney Plus comes into play when people are like Disney Plus isn't very exciting, it's not doing anything new, and you didn't see an immediate drop in Netflix stock just because Disney Plus went started the streaming process. However, and this is indirectly related to what Leon and I talk about sometimes. Disney Plus has really deep pockets, like extremely deep pockets, and they have revenue streams that are coming in from multiple places. So because of that, when times like this hit, their overall income isn't affected as much as a smaller company like Netflix. And so, you just have to understand these companies that you're investing in. Not only, do you just use them because I talk about that more than anybody. Sometimes you have to look at the numbers. Like, what direction are the numbers going in? And sometimes it just doesn't make sense. For me, Netflix doesn't make sense as a long-term play. Even if they recreate themselves, I think it's too much competition out there. Maybe at this level, I will wait a couple months and put some curious money into it just to see what happens. Because normally, if a company snapped that far back this quickly, I would think that it's poised to launch back up. I don't think this is the situation here.
Yeah, we're not. Yeah, we're not in that, like this market. This isn't that market. This market is not snapping anything up. So no, but I agree. I mean, for the most part, Netflix is, it's having big issues. Competition's huge. The cost of content is through the roof. And like Brent said, with Disney, Netflix is just one part of a massive empire that Disney has. Disney makes, I believe, most of the profits.
Disney Plus.
Sorry, Disney Plus. Yeah, Disney Plus. So yeah, Disney makes, I think the lion's share of their money their profits come from their theme parks. So Disney has a cash cow already, on the side. So Disney Plus is really just gravy. If it makes money, Disney doesn't need it to make money, where Netflix needs to make money on this streaming business. So, but I mean, down this low, it's dropped so much. Again, curious money, maybe take a stab at it, kind of maybe for a trade. But long term, yeah, I would kind of, sit back, watch, see what it does. But then what we say, you got to do your research, right? You got to do your research. Netflix is having a really rough time right now, just based on market dynamics and the market in which they play in. And so, and like Brent said, also, and thing I've always argued kind of against is just because you know the company, you're familiar with it, you use it, does not make it a good investment. It can, but that's not like a prerequisite of a good investment. Is because you know the company. No, not at all. And we're seeing now Netflix, at least right now in this moment, has not been a good investment the last couple months, based on just knowing the company and using it. So like we said, always do your own research.
Yep. And so the next one we're gonna look at is Tesla. Now, as you all know, I own a big position in Tesla, and I'm not thrilled with some of the shenanigans Elon Musk is throwing into
your boy Elon.
This is so I'm feeling some kind of way. However, our goal today is to look at the 6 months. So in the last 6 months, you're talking about the stock being down 18%. And so let me make sure you can see the chart. 18% hurts when you either have a big position in it or you're not familiar with what's going on with the overall marketplace. 18% feels pretty good if you are familiar with really going on in the marketplace, because it's not that much. Now, there have been times where I'll say just Tesla's been down, 30% in a very short period of time. I owned it during that time. And for me, this is a time where I actually probably would put more money into Tesla if I didn't have such a big position in it already. I do believe this company is it's a tech company. You know, cars are just one aspect. They're launching a sustainable living division, and then they're also with their sustainable living division. That's going to be revolutionary because they're talking about producing similar to container homes. I want to say the price point is something like $20,000, and I want to say you're like 80% off the grid. That's going to be revolutionary. And with Tesla's brand, I think that's going to do very well because a lot of people want to do tiny house living and they want to have mobile homes that are a little more sophisticated. And when you look at production, having a production model that's replicatable across the globe, because Tesla's global, there's a lot of market share to gain. So, for that reason alone, I'm still a fan. Also, I believe SpaceX, a lot of the technology, when Elon does certain things, it trickles into other parts of his company. So the technology that they're acquiring, developing through SpaceX is going to make its way into the Tesla cars and at some point these homes. In addition to that, Tesla has already confirmed that they have 18-wheelers coming out. As you know, most of these drivers right now are suffering pretty bad because of gas prices. So it's a lot of truckers who are already looking towards these EV trucks to 18-wheelers to start hauling their loads because they can't take the gas prices anymore. So there's a lot of things that are in positive direction for Tesla. Although I will say, I do not like the fact that Elon feels like he's spreading himself very thin. And I wouldn't care if he didn't run the companies, but he's also a very involved CEO. So, you only can do so many things well. I don't care who you are. So that does bother me about the company. And with them shutting down the plant in China, I think that plant only accounts for maybe 15 or so percent of their
Well, not shutting down, just temporary. Why? Because of COVID.
Yeah, temporary. Yeah, temporary shutdown. But it doesn't account for a big production. However, it was their targeted plant for production to lower cost overall, and they were trying to penetrate the Asian marketplace, mainly doing distribution through that particular manufacturing plant. So that will put a pause in that part of the business's expansion. Again, not a big deal because you go back to financials, but their money on the books can sustain them for years and years to come. One other thing with Tesla that I've heard, I haven't done research on this, so this is like alert. You heard it on Investing Education Academy first. Leon, have you heard that Tesla or Elon is talking about buying Roblox?
No.
Yeah. So it's this.
Okay.
Yeah. So again, this is like alert. Made rumor alert. I don't know, but it's discussion out in the world that he may be positioning himself to buy Roblox. So
okay.
Yeah.
I'm not a fan of that, but okay.
He's it's like
richest man on the planet. He can do what he wants. So yeah,
he's got money to burn. So,
right.
But that doesn't have me terribly excited. Although, the metaverse is growing. People do love it, and you can't really deny the hold that it's going to have on our futures. But is Roblox a platform? I don't know. They're coming out every day, new metaverses. So with that being said, you're holding Tesla 6 months is down 18%. For anybody who's watching, in the comments, if you can tell me what you think the 5-year return for Tesla would be, if you are driving, listening to the podcast later on, Tesla 6 months is down 18%. I would be interested in knowing what you all think the 5-year return on Tesla is without Googling it or pulling out your phone and checking it. Because I know you're driving right now, swerving, trying to check it. Don't do that. Don't do that. So I'll stop the suspense. If you've held Tesla for just 5 years, you're talking about having a 1,300% rate of return. I'm gonna say that again. I saw somebody put 3,000%. It might as well be. So
right.
If you held it for just 5 years, you're talking about a 1,300% return over the last 5 years. And I'm pulling out my calculator. I'm like, I just want to see what that is.
I mean, that's
260% rate of return every year for the last 5 years.
So more than tripling your money.
Almost tripling
your money every year.
Every year. So let's put that into perspective. You put 500,000 into an investment. You now would have somewhere north of $1.7 million. Okay.
Yeah, let's say closer to say 2 million, like closer to 2 million. Yeah.
It's closer to 2 million.
Yeah.
And so it 500,000. You're talking about having $1.7-ish million in 5 years.
5 years. Yeah.
If you took 200,000 and you took 200,000 and you put it into Tesla, you're talking 5 years later, you'll have about $690,000. Imagine taking 250, turn it into 690,000. That's enough for you to go back to your investment account, pull out money, more than likely pay off whatever house you're living in, and still have your principals invested in growing.
I mean, with that much, you can buy 2 more houses. Like, you're like Elon at that point. You're just burning money. But I want to make a point also that we're saying what we're showing here is that in the moment, pullbacks, corrections are painful. They're terrible. They're horrible. But as we're showing here, the perspective is over the long term, the market generally goes higher. But what we're not saying over the next 5 years, Tesla will do another 1,000%. We're not saying that. We have
any of these stocks,
right? We don't know what any of these stocks are going to do in the future. The only point we're making is that history shows that when you hold stocks over the long term, there are dips and bips and bumps along the road. But ultimately, if they're solid companies and the economy is doing well, they eventually come back and reach all-time highs. So that's the point we're making. That in the moment it's painful, but if you hold long term, you stay diligent, do your research, buy quality companies. Long term you'll profit.
Yeah. So everybody, we owe you 2 things today, and it's 2 stock picks or cryptocurrency. So you can get our stock or cryptocurrency picks. One will be listed inside of our Facebook group. You go to Investing Education Academy on our Facebook group and search it on Facebook. You'll find us. Or if you're already an IA member, which we hope you are, you can go into the platform and find both of our picks for today. And you can see the running list of all of our picks from the time we started. It's a pretty interesting thing to look at. I will tell you that. So with that being said, we thank you. And again, I will echo what Leon said. This is historical performance. It's no guarantee that the future will be the exact same performance. It could be better. It could be worse. We don't know. And honestly, I'll go out on a limb and say, I think the next 2 years, maybe 3, are going to be really rough for the market. Not rough to the point where I wouldn't invest, rough to the point where I'm going to be smart about how I'm investing. And I'm saying this because I don't want to put words in Leon's mouth. This is where you should be working with professionals. This is where you need to be part of communities that are giving you information that you can then dig a little further on into and see if it makes sense for your portfolio. But if you're out there on an island and you're a new investor, or you really don't have that much experience, maybe you had a run from 2020 to the beginning of 2021, but now you're getting beat down and you realize like, oh, there's actually a system to this.
Mm-hmm.
Yes, there is. And there's a way to look at stocks, and there's a way to kind of move stocks out of your portfolio that don't make sense anymore. It's a way to allocate your portfolio. There's a lot of strategies that you could be using that a lot of people haven't been, because they were running this COVID high. The stock market is just going straight up, and it's always going to go up. And now, which Leon and I have been trying to say, it's not something to play with.
Right. Gotta know what you're doing.
Mm-hmm. Yeah. You don't want to just guess with this. So hopefully this makes sense to you all. Leon and I are doing our best to give our community and you all information that will make your lives better. We are really, truly doing this because we want the best for people out there. And, we want our community to grow, but we could do all of this inside of our community and make our community amazingly happy, but we bring it to you all because it's important. So go through your portfolio, look at the 6 months and 5 years of some of your stocks, whether you've owned them that long or not, and just kind of get a feel for what they've done to familiarize yourself with the behavior of the market. Leon, you got anything before we go?
No, that was it. Yeah, I think that's good. That's a good exercise. Yeah, like I said, we hope you all have revisited your portfolios over the last couple months. Hope you're not waiting to now to do it, but if you haven't, yeah, definitely look at your portfolio, see what's up, see what's down, see what maybe doesn't make sense for you anymore. If you see something that's down 60, 80%, you probably want to dig into why that is, and really do some homework on that, because again, like Brent said, the 2020, 2021 COVID high that everybody was on, that is over. This is now a game of actually knowing how to pick quality stocks that can make money over the long term.
This is crazy. 1,300%
in 5 years.
5 years.
Yeah.
So with that being said, just chew on that one. So everybody, thank you for being with us, and we will see you next Wednesday at 9.